I'm going to talk about year-end strategies for exercising stock options. My name is Stoyan Panayotov. I am the founder of Babylon Wealth Management. I am a fiduciary financial advisor here in the San Francisco Bay Area. You can see my contact information here on the screen. So if you have any questions after this webinar, feel free to reach out and we'll try to get back to you as soon as we can. Today we'll talk about exercising stock options and it's kind of put a focus on the tax planning impact. I know a lot of folks kind of struggle and to plan their taxes around the stock options, to plan their AMTs and much they owe to the IRS. So we'll try to be as clear as possible and we'll try to answer as many questions as possible. So without further ado, let's get started. Just a few words about our disclaimer. This presentation is only for information and educational purposes only. It's not designed to anyone's specific circumstances. So if you have any specific questions or decide to exercise your stock options, please feel free to reach out to us or contact your CPA or financial advisor. Also consider your specific individual circumstances and your investment horizon and risk tolerance. So, now we're ready to get started. So let's talk about stock options. We'll mostly talk about the two types of stock options that probably all familiar with: incentive stock options and non-qualified stock options. We'll touch a little bit more on RSUs and stock purchase plans. Let's spend a few words talking about incentive stock options or ISOs. So the ISOs are the industry favorite. They have a favorable tax treatment. They are eligible for long-term capital gains as long as you kind of follow the strict set of rules. So you can only receive up to $100,000 of underlying stock per year. Any amount over $100,000 will be assigned as non-qualified stock options. When you exercise incentive stock options, you do not owe federal and state income tax, and you need to keep the incentive stock options for at least 2 years from the grant date and 1 year from the exercise date. One caveat, very important caveat about incentive stock options is alternative minimum tax. A lot of people get caught off guard about AMT. They don't understand what AMT is. So let me just kind of spend a few minutes here about talking about AMT. So the alternative minimum tax is a parallel tax system to your conventional tax brackets. It's been designed in the 70s to prevent some people from cheating on their taxes. It has impacted a lot more people. There have been some changes in the tax law in 2017. So nowadays a lot less people are paying AMT than maybe 10 years ago. Unfortunately, those who have incentive stock options could be impacted by the AMT tax system, because in the eyes of the IRS, the economic benefit that you receive from exercising your stock options gets added to your regular tax income. And by calculating the AMT tax brackets, if that amount is higher than what you normally have to pay on your regular tax, you'll owe that difference to the IRS. On the flip side, the AMT is a tax credit. So in the years when you don't have to pay AMT, you'll probably get some of that money back. And again, if that area gets a little bit too dicey and complicated, you certainly need to speak to your CPA about your specific circumstances about how to pay your AMT, how to get it back. So like all taxes in the United States, you have to pay an estimated tax. AMT is not an exception. So say you exercise your AMT in the beginning of the year and it's a sizable amount, you have to pay that to the IRS on a quarterly basis with quarterly payments. A lot of people get caught off guard on that one, and basically they either forget to pay it, they don't know that they have to pay it, and they might have a little bit of a tax surprise towards the end of the year. Usually if you talk to the IRS directly, they might be more understandable, but if you live in the state of California, our tax authorities can be a little bit more strict here. So a couple of other things about ISOs. They expire after 10 years. So once they get vested, you have 10 years to exercise them. They're also not transferable. You cannot give them to another person. And then lastly, about ISOs, if you do not keep them within that required legal minimum, 2 years from grant date, 1 year from exercise date, you will have a disqualifying disposition. So that means that your ISOs will convert into non-qualified stock options and will be treated as such. That could be a good strategy depending on the kind of circumstances, especially if the stock price has come down quite a bit since you exercise it, but we can talk about it a little bit later. Moving into the next slide. So non-qualified stock options. Non-qualified stock options is kind of like the cousin of incentive stock options. Obviously, they're the less favorable one. They get a less favorable tax treatment. And the reason why is because exercising your non-qualified stock options is a taxable event in the eyes of the IRS. You will owe federal income and Social Security, Medicare taxes on the difference between the fair market value and the exercise cost. And you can see how that could be a problem if you are working for a startup and you're exercising non-qualified stock options, and you may owe like a significant amount of taxes without being able to sell any shares to fund the taxes. So what happens usually with startups, a lot of folks end up waiting until the company is about to go public to exercise their NSOs. It's not always the best strategy, but because of the huge tax impact, a lot of people tend to wait until they have some kind of a exit event. Just a couple more words about non-qualified stock options. The long-term capital gains are due long-term capital gain taxes are due after holding your shares for longer than 1 year. If you sell your shares less than 1 year, obviously you have to pay short-term capital gain taxes. There's also another option with non-qualified stock options. It's called early exercise. That's when you exercise your shares and you sell them immediately after you exercise them. In that case, you will owe only the taxes on that bargain element at the time of the exercise. We'll talk a little bit about RSUs here. So RSUs are also very popular, especially if your company is publicly traded. So the way RSUs work is you tend to receive them as a signing bonus or a year-end bonus. They have a vesting schedule, so most of the RSUs will vest over typically 4-year period. There's some differences, but 4 years tends to be like the traditional one. So the entire value of your vested shares is taxable as ordinary income. And typically, public companies tend to sell some of your shares to fund the taxes. Like as we live in California, they'll sell enough shares, usually if 22% on federal and 10.23% on California withholdings to cover your taxes. So that could become a bit of an issue because depending on your tax bracket, if you're in a much higher tax bracket, you might end up owing some extra money to the federal budget. So this is where, obviously you have to work with a CPA and figure out how to address those issues. So most startups, because of the issues of like funding your taxes, most startups tend to have like a dual trigger vesting schedule. So even though your RSUs get vested, you don't pay taxes until you actually have an exit event, either some type of buyout or an IPO. And lastly, what I wanted to share about RSUs is that you can also sell those RSUs, and similar rules apply like with the NSOs. If you hold them for 1 year or more, you'll pay long-term capital gains. If you hold them for less than 1 year, you'll pay short-term capital gains or losses. Moving forward, employee stock purchase plan. If you work for a publicly traded company, there's a good chance that you will be invited to join the employee stock purchase plan. It's a very good option to kind of participate in the company. A lot of folks don't have other employee compensations outside of the employee stock purchase plan, so that's why we wanted to talk about it. There is a 25,000 annual limit. You will receive typically a 15% discount on the market price. Most plans have a look back feature, so you will receive the lower price between the beginning of the period and the end of the period. However, there are also some differences. Not all plans have a look back feature. Some plans just, you basically get what you get at the end of that period. So unlike RSUs, the ESPP shares are not taxable until they're sold. However, in order to meet the requirements, you need to keep your shares 2 years after offering. The offering date has passed in 1 year after purchase to qualify for long-term capital gains. So the discount that you receive, that 15% discount, is taxable as ordinary income, and the long-term capital gains are due on the difference between the sale price and the market price on the acquisition date. So now, after we covered some of the main types of equity compensation, so let's talk about some tax matters, since we here to talk about tax planning. So obviously, when you exercise your incentive stock options or non-qualified stock options, one thing you need to think about is your bargain element. The bargain element is the difference between the fair market value or the market price of your shares minus your exercise cost. So the bigger that difference is, the bigger your taxes will be, or AMT. So the first thing when you need to when you start thinking about exercising your stock options is identifying that. How big is the difference? How big is the gap? If the gap is really large, then most likely you will owe a large amount of taxes. So again, if you're in that situation, talk to your financial advisor, talk to your CPA, or feel free to reach out to us. Again, so the next step, obviously, if you want to reduce your taxes, you also have to think about prioritizing long-term capital gains versus short-term capital gains. So if you have a long investment horizon, obviously, if you're willing to wait, long-term capital gains are preferable because they're taxed at a lower tax bracket, usually between 15 and 20%, while your conventional traditional tax brackets might be as high as 37%. And added to that, obviously, you can pay California state taxes. So the advantages of exercising your stock options is that you start the clock now. As soon as you exercise your stock options, you start the clock on your 1 year holding period. The longer you delay that exercise decision, the longer you delay the start of that clock. Also, we kind of mentioned earlier, all taxes, including AMT, are due quarterly. And we often, work with some clients on that, and we often see people who either ignore that or don't even know that they have to pay it quarterly. So again, if you have any issues with that, feel free to contact a CPA or talk to us. And lastly, the big dilemma about stock options, if you own stock options, is like, should I exercise now or should I wait until the IPO? And kind of the next slide will kind of talk about it a little bit, kind of visualize kind of the difference. I don't know if you can see here. So on the left side, you can see the payout if you exercise early, and on the right side, you can see the payout if you exercise when the IPO happens. Obviously, there's a lot of moving parts, and this is just an example for visual purposes only. And there could be differences, but in this example, you can see that our client has just by deciding to exercise early and wait until wait to sell after the IPO, our client is making $283,000 versus a similar person who decides to not exercise today and wait until the IPO. Obviously, there is a $50,000 of gains that you'll be willing to give up just because you don't want to take that risk of exercising your shares early. Obviously, there's a lot of things that take into consideration between exercising and waiting till the IPO. It's not just if you're willing to wait. It's all about can you pay for your shares? Can you afford paying the taxes? What is your risk tolerance? What is your investment horizon? Do you trust the management? And so on. But those are all big questions. So again, if you find yourself in a situation where you have to make that dilemma, feel free to reach out to us, CPA, financial advisor. And now, kind of lastly, we're going to touch on about year-end strategies. So obviously, you have a kind of a full list here. So we're just going to kind of talk a little bit about each one of them. So you can exercise your ISOs up to the AMT break-even limit. So every year you'll get a little bit of a kind of an AMT credit, sort of like you can exercise a certain amount of ISOs without paying AMT. So if you're not fully convinced about your company or you're not want to put a lot of money in AMT, so that's one option. You exercise up to your AMT break-even limit. You don't have to worry about AMT, and you still kind of have some piece in the game. Your second option is you can exercise a lot more ISOs during high-income years. Obviously, everybody's situation is a little different, but if you happen to have to be in a high-income year for whatever reason, maybe you have a large payout, the chances are very high that you can exercise a larger number of ISOs that year without paying AMT. So the next strategy, if you have non-qualified stock options and you want to think about how you can exercise your non-qualified stock options, you can, if you want to be conservative, you can basically exercise just enough non-qualified stock options to keep yourself in the same bracket where you are right now. So if you're 24% tax bracket and you don't want to jump over 32%, you can just exercise X number of NSOs, which will keep you within that tax bracket and you don't jump over the next one. Another strategy will be to kind of, let's say if you have AMT credits, if you have, let's say if you have paid AMT in previous years and you have that, large credit sitting kind of in your back pocket, you can use it to exercise NSOs or receive large RSU grants, and kind of when you put those together, they will potentially have kind of offset each other, and your net tax impact will be a lot smaller. And then kind of going down the list, especially this is probably relevant to a lot of folks in 2022. A lot of tech stocks have been down like more than 50%. A lot of startups are probably like holding their valuations. So if you happen to have grants that have a very low bargain element, so in that case, the fair market value or the market price will be close to your exercise cost. Those will obviously, exercising those options, those grants will have obviously a lot lower tax impact versus other grants. So if you happen to have those grants, take a careful look at your various grants, various exercise points, and pick what makes the best sense to you. And then, so since we're having this at the end of the year, like if you have to exercise your grants no matter what, maybe you're leaving the firm or have any other circumstances, maybe it would be a good strategy for you to kind of spread your exercise window between 2 years, and that kind of spread your tax impact between 2 years. Obviously, you have to kind of run the numbers with your accountant and see if it makes sense or not. A couple of other strategies that obviously kind of they're valid all year round, like the 83B election. So 83B election will allow you to exercise your stock options early even before they get vested. Usually, the benefit of doing that is that you will avoid paying large taxes. But however, obviously that the downside of that is you'll have to pay some amount of money to your company to own those shares. So depending on the kind of the situation, it might make, if the amount is something you can afford, and you believe in the company, that might be something you can want to consider. Tax loss harvesting is another strategy. It's not so much related to exercising your shares per se. It's more about like kind of the after effects, or if you're holding your shares for a year or two, and now you're deciding to sell them at a gain. What you can do with tax loss harvesting is you can potentially harvest losses in another part of your portfolio. So offsetting losses with gains will potentially lower your tax burden. And kind of lastly about this, the strategies, as you can see, a lot of the strategies, they can in most cases you will implement them in some combination, which really depends on the type of grants you own, what is your tax bracket, kind of what is your filing status, your income for the year. So you will need to have a comprehensive plan in terms of your exercising strategy. And if you probably heard the old Chinese saying, when is the best time to plant a tree? The best time was 10 years ago, and the second best time is now. So if you're sitting on your pool of stock options and you're trying to decide what to do, now is the best time to do it. The longer you wait, the longer you may have you'll have a lot less time to decide and a lot less flexibility in terms of decision making, timing, taxes, and so on. In order to do that, you'll need a comprehensive plan. The comprehensive plan will basically combine your kind of various pieces of your financials and kind of put it together to come up with a strategy that kind of tailored to your specific needs and your specific tax circumstances. And lastly, if you think that stock options is kind of out of your league, it's getting way too overboard, don't hesitate to work with a trusted financial or tax professional. We are here to help. We are here as a resource. We're here to educate and keep everybody kind of on the right track. So now we've been talking for quite a while. So if you have any questions, feel free to drop it in the chat. So one question is coming here. When is the best time to exercise my stock options? Is it at year end or beginning of the year or throughout the year? Well, as I kind of mentioned earlier with the Chinese proverb, the best time to do it was 10 years ago. The second best time is now. Depends on the situation. If you haven't exercised your stock options at all, obviously year end is a good time to do it because you have a very good idea about your tax income for the year, and you have a very decent visibility of your income for the following year. So doing it at the end of the year obviously has a lot of advantages. So you have a lot of information ahead of you. On the other hand, exercising it in the beginning of the year gives you a lot of flexibility. So if you do it in the beginning of the year, you obviously have 12 months ahead of you to make changes in your strategy. However, most of the things we kind of talked about, they can be done throughout a year. So you're just going to have to find out what works best for you. Another question is, what do I do with my stock options if they're underwater? Great question. Probably a lot of people are in a similar situation. So a lot depends on the kind of the situation, and I know the term underwater has been used a little bit loosely. So obviously, if your fair market value is below your exercise cost, that doesn't make sense to exercise your stock options because you're basically going to be paying $10 for something that's worth $5. So, and I think most companies like Carta won't even allow you to exercise. If you're in a situation where you have already exercised your stock options and subsequently the price have fallen dramatically, then you have some options on your hands. So obviously one strategy is just to wait. You don't have to do anything, just wait until the price recovers. Another strategy is just to sell your shares at a loss. Basically, you will obviously probably not the ideal situation to sell your shares at a loss, but if you need the money, maybe that's something you need to look into that. And then if your ISOs, obviously, if you have exercised them at let's say at 100 and now the price is 20, and if you want to sell them, you will either you have to wait for the 2-year, 1-year period, or you can do a disqualifying disposition. Either way, you will owe some type of either short-term. You will have to basically owe some taxes on that, depending on what your exercise cost is. And I think that's about it. So, well, I know we've covered quite a bit of ground. So thank you everyone for joining. If you have any questions, don't hesitate to contact me. Here's my contact information again. And thank you very much for joining us today, and have a great day.